Welcome to The Interest. I'm Sarah Wolak. In a down market, originators are always looking for ways to trim production costs. After chatting with Chelsea Bullock from processing firm Wemlo, it seems that contract processors may just be the solution. Let's hear what she had to say.
If you're an LO, you want your business focused on getting the sales in the door and making sure that you're taking care of your clients. Your skill set is not to hire, train, and fire people.
The unsung heroes and cost cutters of the industry might just be contract processors. The best part? They don't expect to be part of the lone team. Chelsea Bullock works for Wemlo, a third-party processing firm that helps brokers and LOs mitigate costs.
So we get leads from a variety of different sources. They either email us directly because we are on some of the lenders' preferred processing lists, or they can schedule a demo right on our website.
Bullock says that matching contract processors with a broker or LO is a lot like a dating app. They want to make sure they select someone who will best match the energy and practices of who they're working with.
And what we're doing in the onboarding is really getting a good sense of how they do business, right? We say a lot of this is like matchmaking, finding the perfect processor to go with the perfect broker or LO.
Bullock says third-party processors keep costs down. Wemlo sets companies up with a team of processors so that in the event of emergencies, the loan always goes through.
So we're matching them up with brokers based off of what products they understand, where they're located, time zone's a huge one, and then also lenders that they've worked with.
The choice to have an in-house processor or an employee really depends on the employer's preference. On one hand, a permanent processor can latch onto a company's culture. But on the other hand, it's a lot of work to train someone to see if they're a good fit.
If you have a processor that's on staff, that's a constant salary that you have to pay out. And so if you use a contract processor, it's at zero cost to the LO or the broker. It's passed along to the borrower on their loan estimate or their CD.
To read more about these flexible underdogs of the industry, check out the story on mortgagemakermag.com. Reporting for The Interest, I'm Sarah Wolak.
My name is Thomas Hall. I went ahead and used the Southwest AI app, and I put in a difficult loan scenario with some tax returns and everything, and I had somebody else already underwrite it. When it came back, it was almost identical within like a few dollars, and it took about 30 minutes instead of a whole day or two for somebody to analyze that. So yeah, that AI is going to be the best thing in the whole industry. So stay tuned.
This is David Luna, President of Mortgage Educators and Compliance, with your updates for The Interest. More and more sentiments are growing that there will be an increase in the Fed funds rate November 1st. We've heard hawkish comments from Federal Reserve Chairman Jerome Powell. But what do the other members of the Federal Reserve think and feel about a future rate hike? Vice Chair for Supervision Michael Barr, quote, "The Federal Reserve may need to raise interest rates one more time this year before holding them." Federal Reserve Bank of Cleveland President Loretta Mester, "This move will, quote, depend on how the economy evolves relative to the outlook," close quote. And the results of the Fed's actions, quote, "I foresee inflation declining to about 2.5% next year before closing in on 2% in 2025, said John C. Williams, President and CEO of the Federal Reserve Bank of New York. Most of the 19 Fed officials anticipate one more rate increase for this year. If we look at the Wall Street Journal, their estimation is also, yes, rates will go up one more time. But I think the real question is, what will this do to mortgage interest rates? I believe that most of those rate increases have already been baked into the rates we are seeing today. Lenders have about 324 basis point spread, which is way above normal, already baked into their pricing. Normal is 170, 175 basis points, meaning that rates should not increase suddenly after the FOMC meeting. Doug Duncan, chief economist for Fannie Mae, answering the question of why rate spreads are so wide, said, quote, "No fixed income investor thinks that mortgage-backed securities with 7% mortgage rates will be there when the Fed finishes the inflation fight. They're going to cut rates, and that will prepay. the Fed is not an economic buyer. That is, they aren't buying for risk-return matrix. They are buying to affect the structure of markets. So they are a policy buyer, close quote. The country dodged an economic shutdown this past weekend, and then rates went up. Why? When there is bad news, it is good for interest rates. Positive news does the opposite. So now that a potential crisis has been averted, rates reacted by going up. But this was just kicking the can down the road a little way. By mid-November, Congress will have to deal with this situation again, meaning what happened last weekend was just a temporary fix. The Mortgage Bankers Association wrote in a recent analysis, quote, "A shutdown lasting a few days would suddenly inconvenience lenders in processing loans. However, a longer delay would have more severe impacts," close quote. Add to that, the possibility of a Fed funds rate increase will make November a very interesting month. For The Interest, this is David Luna, president of MEC.
There once was a man named Jim, whose retirement prospects were grim. He heard of reverse mortgages, a solution to his financial stresses. Now his golden years are no longer dim.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.